Very good morning, students. Welcome back to today's class on retail management. So, in the previous class, we completed the third unit, which focused on traditional or unorganized retailing and organized retailing. So, in this particular class, we are going to focus on retail pricing. So, the topics that we'll be covering in this particular unit are retail pricing, factors influencing retail pricing strategies, retail promotion strategies, management and evaluation of relationships in retailing, and retail research. So these are the topics that we'll be covering. So let's start with retail pricing. Now, the pricing technique is used by the most retailers as cost plus pricing. Now, what happens is the manufacturer generally, yeah, he determines the pricing based on the cost of manufacturing plus his profit margin plus other margins, dealers margins like plus distributor margin, wholesaler margin, and the retailer margin. That's the reason you keep the MRP. Now the word MRP. Now when we are buying any product, we come across this particular term called MRP. Now MRP is the price of the product, right? So when we expand this particular term called MRP, it comes as maximum retail price. It means to say that a retailer can sell the product at a price lesser than that also, right? But he cannot afford to sell anything beyond that particular price. So if a retailer is selling beyond the price that is mentioned on the product, now as a customer, as a consumer, you have every right, right? As a customer consumer, you have got every right to raise a complaint. And we have Consumer Protection Act in India, so we have got every right to raise a complaint in the consumer forums and to get justice for the exploitation that you have undergone. Okay, so that's the reason generally, I mean, in the past when we did not have consumer protection laws and there was no awareness among the customers. Now people have been taken for granted and the people were being exploited by the retailers. All right. Now that we have a lot of awareness and Consumer Protection Act is into force and a lot of awareness has been created and generated among the customers. Now, today, no retailer sells a price beyond the maximum retail price. Okay. Now, pricing is again very, very important in retailing. All right. Now, pricing plays an important part, especially in a high price sensitive market like India. Right, in some parts of the world people place a lot of importance on the quality, and they're willing to pay a premium in order to own a quality product, right, in order to own that particular brand. But in a country like us, which has huge population, right, population of more than 130 crores is a very huge population. Now in such a highly populated country, right, where we have the rich population amounting to just 10% of the population, right, and the remaining population is middle class and the lower class. So with this middle class mindset and the lower class mindset, people are highly sensitive, highly price sensitive, right. So price discounts and all, they play a very important role. So in light of that, right, where even a price discount of 1 rupee or 5 rupees makes a huge difference in terms of the sales. Now pricing the products in the retail market is extremely important, right. Say if one particular retailer is giving discount as pricing his product, say the MRP of the product is 40 rupees. Now kirana shop will sell you only at 40 rupees, and if that particular customer is a regular customer and he knows him very well, he'll give him 2 rupees discount and sell the product at 38 rupees, right. Saying if you go to the organized retailing, now an organized retailer might be selling at 36 rupees and someone might be selling it as 35. All right, so people tend to move to that particular retailer who is selling at 35 rupees, right? So that's how this pricing plays a very key and crucial role in retailing. Now let us look at the objectives of retail pricing. Right, every retailer he needs to consider the overall financial, marketing, and strategic objectives of the retail business. Based on that, we'll have to fix our objectives. Similarly, we'll also have to take into consideration the characteristics of a product or a brand. And sometimes customer price elasticity and price points are very important. Say, for example, for certain products, for essential products, we have inelastic demand. Say a product like milk. So a product like milk has got inelastic. Product like rice, wheat, they have got inelastic. So even if the price is going to increase, no, people are still going to buy that particular brand, right? A vegetable like onion, and some, and you know what, almost a decade back or so, now the price of the salt has shot up. I mean, kg salt was selling at 5 or 10 rupees those particular days, and in places like Delhi it has shot up to 60 rupees suddenly. Kg salt was selling at 60 rupees. Even then the demand did not drop, because there's no substitute for certain, for all those particular products where you don't have any substitutes. Obviously the demand for those particular product is going to be inelastic. Okay, and resources available, they also play an important role. Now, well, let us look at the one of the most important objective that a retailer considers while pricing his product, and that's the profit objective. The retail store may price its product with the objective of maximizing the profit in the short run or the long run, or sometimes both. Now, the objective of profit maximization, it must be studied carefully, because it may lead to unethical practices such as overcharging and sometimes even deceiving the customers also. This in turn may lead to some form of intervention either by the government or consumer groups, some NGOs. At other times, the marketer may price his product with the objective of obtaining only a target rate of return on his investment. This is particularly with products in the mature stage of the product life cycle, right? So profit objective is always being considered, right? But it also depends upon the demand that you have created for the product, and it depends upon the launching, right? Pricing strategies, they also play an important role. Now next is the market share strategy. The retailer or the marketers may may price his or her product with the intention of increasing his market share or stabilizing his market share. Now he can set the price of this product lower than his competitors also, in order to gain more market share, right? So if the product is for making the product acceptable, to increase the product acceptance, sometimes retailers reduce the product price of the product, right? They use this particular penetration strategy, and in order to increase this particular product reach. Now let's look at competitor-oriented objective. The retailer or marketer may increase his product to counter any existing or prospective move by his competitors. Retailer may deliberately price its merchandise low. Sometimes, now why they deliberately lower their price? Let us look at the reasons. To discourage potential retailer from entering. Sometimes, if a new retailer is entering into the market, and you don't want a new business person to enter into that particular market, so obviously you cut down the prices. So when you cut down the prices, now what happens, the return on investment of for that particular retailer will be very high, right? And low margins and price discounts and low margins, they act as inhibitors, right? Now they act as hindrances for a new retailer to enter into the market. So whenever they feel that a new person, a potential retailer is entering, who is going to threaten our existence, they are going to resort to this particular ploy called price discount, or reducing their particular price. And sometimes they reduce this particular price, and the other reason why they are going to lower the price of their merchandise is to advance the exit of potential competitors and marginal firms from entering the market. Say if those products are if those particular retailers are already there in the market, and you want to decrease the competition, move it from monopolistic competition to oligopoly, or at least in the monopolistic competition to do away with cutthroat competition. Now sometimes organizations resort to this particular price drop. So when price drops, the marginal players who are there, they may not be able to survive. So since they could not cannot survive at those particular prices, now they will be forced to move out of the market, right? Say for example, if the price of the product is 40 rupees, and the cost of manufacturing the product is like 36 rupees. Okay, cost of manufacturing that is fixed at 32 rupees. Okay, so now profit margin, dealers margin, everything is in this 8 rupees they operate. Okay, now somebody, person who is directly purchasing it from the manufacturer, and then who is purchasing at a very bulk purchases. So he might be getting a price discount of 30 instead of 30 rupees. He might be purchasing at 30 rupees. Now, what is he going to do? This particular 2 rupees is going to pass as a discount. And when he passes this particular 2 rupees as a discount in the highly price sensitive market, people are going to flock and buy his product. For the remaining retailers, especially the marginal players, they cannot sell the product. Even if they are going to decrease the product by 50 paise, they will not be able to operate the business. And if they decrease it by 1 rupee in order to compete with him, decrease it by 1 rupee or 2 rupees, in the short term, they may manage the business, but in the long run, it's going to be a death blow. It's going to be a fatal knock, and that particular business will be knocked out of the business, knocked out of the market. No, it's sometimes this price flows are going to have such disastrous effects. And the other reason why we see retailers deliberately decreasing the prices to spoil the market of retail competitors with the eye on getting future benefits. Now, in order to increase their particular market share, they again resort to this particular tactic. Now, the other objective of our retail pricing objective is buyer-oriented objective. Now, the aim of this buyer-oriented objective is to maintain socially acceptable prices and to be fair to customers. All right. Now, we have this particular concept of super bazaars and Raitu bazaars. Now, these are buyer-oriented, as these retail chains practice the pricing objective of bypassing the intermediaries and sharing savings with the ultimate customers. So they give the product for the customer at a lower price, and at the same time they'll also be getting a better deal. Now sometimes government objectives also will be there. The pricing of some products may be constrained by existing laws or may be influenced by government action. Say for example, prices of petrol, prices of vegetables in India, to a large extent, they are controlled and influenced by government. Okay. And sometimes product oriented objectives, right? So the last object that we have is product oriented objectives. So here, the retailer or the marketer at times they make their offering more visible by means of pricing. Now, customers are usually attracted by the advertisement in newspaper highlighting special offers and discounts. Now, with a lower price, the retailer can therefore catch the attention of the buyer, and this will help him to introduce new offerings and increase the sale of weak products. Many of the retail stores in India, especially Big Bazaar, uses this particular pricing technique. Right, product-oriented pricing in other language, we call it as EDLP, and it was introduced by Walmart, the world's largest retail outlet. Right now, what is this concept of EDLP? Everyday low pricing. Right. So on every day on one particular products, they are going to today, if it is groceries, now tomorrow it can be electronic products, the day after tomorrow it can be apparels or textiles, and the day after that home needs, the day after that kitchen needs. So on like this, on every throughout the week on one particular specific category of products, they'll be decreasing the prices, they'll be selling at a discounted rate. All right. Now this again will, when you go for this particular strategy called everyday lower pricing, now the customers are going to flock to that particular retailer store, and they also ensure that when you want to buy that at discounted rate, they generally go for cross selling. Right, if you're buying the product individually, it's going to cost you 60 rupees, but if you're buying cross selling at the same price of 60 rupees, you're also getting an additional product. Now customer thinks that's a benefit, but in fact they are trying to move away the products that are not able, that have got weak sales. Now let us look at the factors that influence retail pricing. Now we generally have two types of factors influencing the retail pricing. There are internal factors and external factors. So let's look at the internal factors that influence the retail pricing. So we have got totally 5 internal factors, and they are manufacturing cost, the predetermined objectives, the image of the firm, product status, and promotional activity. So these are the 5 factors which are going to influence the retail pricing. So when you look at manufacturing cost, now the retail company considers both fixed and variable costs of manufacturing the product. Now the fixed cost does not vary depending upon the production volume. For example, property tax, right? The variable costs include varying cost of raw materials and cost depending upon the volume of the production. For example, something like labor, right? So this also influence the retail pricing. Say if the fixed pricing is more, and then you are going to have a stable price. You will not see price fluctuations. But if the variable costs are more than the fixed costs for those particular products, we definitely see price fluctuations, right? Prices fluctuating here and there. Next is the predetermined objectives. The objectives of the retail firm varies with time and market situation. If the objective is to increase the return on investment, then the company may charge a higher price. But if the objective is to increase the market share, then they're going to lower the price. You see how an organization's objective is going to decide the price of a product. So if the objective of that particular organization is to increase their return on investment, then they're going to increase the price. But if their objective is to increase their market share, then they're going to lower the price. Similarly, image of the firm also influences the price. The retail company may consider its own image in the market. For example, companies with large goodwill, such as Procter and Gamble, can demand a higher price for their products. So those particular products, I mean, so those particular organizations which are branded organization and which have got a strong brand pull, right? Say, for example, in certain categories, we have MTR. MTR has got a very strong brand pull. So even if the product is going to cost a rupee or two more than the other products, than the other competitors, even if it is going to cost a rupee or more, people are still going to buy MTR. Now, the same is the case with Kisan also, Kisan Jam. Right now, it is Kisan Jam. I mean, even if they charge premium, people are still going to buy that because of the image of the firm. Now, sometimes the product status also plays an important role. The stage at which the product is in its product life cycle also determines the price. At the time of introducing the product in the market, the company may charge a lower price in order to attract customers. So when the product is accepted in the market, so that when it moves to the growth stage, then the company will increase the price of the product because now that the product has been accepted. And the last factor that influences the pricing is the promotional activity. If the company is spending high cost on advertising and sales promotion, then it keeps its product price high in order to recover the cost of investments, the investments that they're making on advertising and sales promotion. So these are the internal factors which influence the pricing. Now let us look at the external factors. So here are some of the external factors that influence the pricing. Now the first external factor is competition. All right. In case of high competition, prices may be set low to face the competition effectively. And if there is less competition, the prices are generally kept high. Right. So whenever we have got very high competition, they decrease the price so that marginal players, we have already seen, no, so those particular people, the marginal players who may not be able to compete at such particular prices, now they move out of the market, right? So when they move out of the market, obviously the competition drops. When the competition drops, then they're going to increase the product price again. Now sometimes the buying power of consumers also determines setting the price. The sensitivity of the customer towards price variation and purchasing power of the customer, they contribute. See, we have novelty products which charge high price, and similarly we have got groceries. Right now, groceries again, we have in India, we generally, even if we go to in organized retailing also, we generally have two types of products. Right now, some of those products are packaged products, and some of those particular products are sold in loose. You go to Spencer or you go to DMart, organized retailers, you'll find it there. right? Say if you are buying this particular idli rava, something like that, if you're buying a product like that, or if you are buying a product like dal, now packaged product price will be obviously high, where they are going to give you a premium quality product. Since they are giving you a premium quality product, they are going to price it at high. And similarly, the same product but with low quality, now they are going to sell it in loose, where the product price will be low. So depending on the income level of the customer, they choose whether to go for packaged product or whether to go for a product which is available at loose. The buying power, now that's going to decide. But in case of some novelty products, obviously they are going to charge a more, because most of these products are nothing but brands. So brands obviously charge a premium. All right. So we have got the branded watches which cost in lakhs of rupees. Similarly, we have got branded automobiles which cost crores of rupees. All right. Okay. Say, for example, Rolls Royce, a branded automobile like Rolls Royce, you are not going to get a Rolls Royce product for 10 lakh or 50 or 20 lakh rupees. No, obviously not. You want to own one, you'll have to shell out crores in order to own. Similarly, a brand like Ferrari, brand like Lamborghini, no, they are going to charge, right? Below 50 lakhs, you don't find any product. The starting price will be from 50 lakhs onwards. All right. So depending on the buying power of consumers also, sometimes the prices are determined. Next is the government policies. Now, government rules and regulations about manufacturing and announcement of administered price can increase the product. Now, sometimes, government policies also, they increase. Say, for example, these days, government is increasing the fuel prices every day. Every second day, they increase the fuel price. But whenever the elections are approaching, they decrease the price. Now, immediately after the elections, they increase. Now, till last month, we had these elections going on in West Bengal. As long as we had elections going on in West Bengal, there was a price drop. They did not tinker the price at all. The moment they lost the elections in West Bengal, they started increasing the price every day. All right. Okay. So now, government policies like that, now they also impact the prices. Now, similarly, market conditions. All right. If the market is under recession, now the buying will be less. If the market is under boom, we find more consumption. So when there is more consumption, because of the demand, price increases. When there is no consumption, because of lack of demand and more supply, the price decreases. And finally, the last factor that's going to influence our pricing, the external factor, is levels of channels involved. So more the levels of the channels, the deeper the level of channels, the higher would be the price, the product price of the product. And the lesser the levels of channel, the prices will be less. So that's the reason in a nearby neighborhood store, where we have deeper levels of channels, like the product comes to the distributor, now initial to the carrying and forwarding agent, from him to the distributor to wholesaler, and then finally it comes to the retailer. That's the reason he's going to sell the product at 90 rupees only, 2-liter bottle of Coke. Right? But when you go to DMart and all, they're going to directly source it from the manufacturer. Right? Manufacturer to the retailer. You don't have any other intermediaries. Now, since you don't have any other intermediaries, he's going to give you a huge discount, because he's saving the money on retailers margin, on wholesalers margin, saving the money on distributors margin, and carrying and forward agents margin. Since he has got he's saving money on all these particular counts, now he obviously decreases the product. So the levels of the channels involved, they decide the the price of the product. More the levels of channels, obviously the product price will be high. Everybody needs a pie, everybody needs a share of the pie, everybody needs his profit margin, everybody needs his revenue margin, so the product price increases. And where we don't have the we have got very less channels or minimum level of channels, there obviously the product price is going to be less. Now let's look at some of the pricing strategies, retail pricing strategies. So basically, we have certain types of retail strategies. One is demand oriented pricing strategy. Second is cost oriented pricing strategy. And third one is competition oriented pricing strategy. And the last one is differential pricing strategy. Now let's look at the demand pricing strategy for today. Now here, in case of demand oriented pricing strategy, the very term, the very name demand oriented is self explanatory, right? That itself explains us. So what does it explain? The price charged is high if there is high demand for the product, and the price charged is low if there is low demand for the product, which means to say demand and price are directly proportional to each other. If the demand increases, price increases. If the demand drops, price also drops. So based on this particular demand oriented pricing strategy, we have got certain strategies based on the demand for the product. We have got certain strategies. Now the first strategy is price skimming strategy. All right, we call it as price skimming strategy. So what they do in case of price skimming strategy is when they're launching the product in the market, they launch at a high price, right? Because they are building a brand and they say you're buying this particular brand, you're not buying a product, you're buying a brand. Now, since you're buying a brand, you'll have to pay premium. If it's a product, you not pay premium, but since it's a brand, you got to shell out a premium. So that's the reason they choose this particular skimming strategy. And later, once having entered into the market with a bang, later at a later stage, say the product reaches the maturity stage or something like that, from that particular stages onwards, they are going to decrease the price of the product. And the other one is the odd even pricing. Many a time when we go to the market, we come across this particular prices called 99 rupees or 49 rupees, right? Now it psychologically, for humans, 99 is a double digit, and you add 1 to that, it becomes the 100, it's a triple digit. Now we generally assume that double digit is less than triple digit, but the difference is going to make is just 1, right? Now sometimes this particular odd even pricing, they also make a difference. Now they are going to play with the psychology of the customer. Next is the penetration strategy. In order to gain market share, right? So here the objective is not the return on investment. When you are focusing on return on investment, you'll go for skimming strategy. But if you're focusing on market share, say you want more market share in the market, you want to be the market leader, then you choose penetration pricing strategy. So what is this penetration pricing strategy? The price is reduced to compete with similar products to allow more customer penetration. Right? They're going to decrease a product that at the time of launch. Say Jio, when Jio was launched, it used this particular penetration strategy only. They said everything is free. Now free SIM and free Wi-Fi and free phone calls for 1 year. You need not pay anything, not even a single rupee. Maybe if with all you're going to pay, there might be some registration charges, but for that, no other charges. And later, having gone very deeply into the market, right, giving free for almost 1.5 year, for almost 1.5 year, and that too giving this particular free data and everything during the time of demonetization, when people needed data very, very badly, right? When people needed this particular data very, very badly, then they said we are going to give free data, right? And then having used this particular free, having become accustomed to this particular free, and having provided better services, because in some areas only Jio network works, and most importantly in some areas only Jio data works. Now Airtel data, Idea data do not work, only Jio data works. So having created such pockets, they were able to penetrate very deeply. And then they started increasing the price. Now, in the meanwhile, customers got addicted to Jio. All right. So when they started increasing the price, they were unable to give up this particular Jio also. Now they got accustomed to it. Right. Very clever strategy. Next is prestige pricing. All right. Now this prestige pricing is done for branded products, but again, brand again here depends upon the customer. Now, if the brand is able to register itself strongly in the mind of the customer and it has got very good recognition and social acceptance, this is very, very important, right? Manufacturing calling this particular product a brand, no, that's not a brand. Now, brand has to be first registered in the mind of the customer. Point number one. Second thing, it has to be socially accepted. If there is no social acceptance, it dies as a brand and remains only as a product. Okay. So when the marketer makes a careful attempt of registering it strongly in the mind of the customer, and then when the brand is socially accepted, then obviously they are going to charge a very premium price. The price is going to be very premium price. Then in that particular case, where it has been registered in the mind of the customer and then it is socially accepted also, then obviously the customer will be willing to pay a premium. He will be willing to pay extra money to own that particular brand. Okay. And the last strategy here we say is price bundling. All right. Now the offer of additional product or services combined with the main product. So what we happen to do in case of price bundling, right? Identify those particular, the retailer has to identify those particular products which are fast moving, which have got very good demand in the market, right? Everyday moving, fast moving, high volume products. Identify them and identify those particular products which do not move at all, right? So which do not, then you bundle both of them. So single product, if you are selling at 60 rupees, when you bundle them, you sell it at another 10 rupees you add and then 70. So when a customer makes a comparison together, if he's buying separately if he's buying, it comes to around 100 rupees. But when he's buying it together, it's coming at some days there he is able to save 30 rupees. Now this is what is going to, even though customer does not have the need for the other product, and that's the reason it's low volume, because customers don't need it, right? So even though they don't need it, because it is coming like a move for just 10 rupees extra, it's coming, they are going to buy it. Now that's how price bundling works. So these are the various demand oriented pricing strategies that we have got. In tomorrow's class, we shall discuss regarding cost oriented pricing strategy. Till then, stay safe. I wish all of you a very pleasant day.